Welcome. Construction is one of the toughest industries in the world to manage financially, and the single biggest reason is cash flow. Long project timelines, milestone billing, retentions, subcontractor obligations, and volatile materials costs create cash dynamics that general business accounting simply doesn't address. In this video, we'll work through those challenges and how specialist accounting support helps builders stay on top of them. I'm from the advisory team at Quantum House Australia, accountants and tax advisors. Here's our plan for the next quarter of an hour. We'll start with why construction is uniquely vulnerable to cash flow stress and the structural reason behind it. Then we'll work through the key levers: progress claims and revenue recognition, managing retention amounts, and subcontractor payment obligations. We'll cover QBCC compliance for Queensland builders and a retention trap that catches people out. Then a worked example, a practical toolkit, the common pitfalls, the key takeaways, and how we can help. Let's start with why this matters so much, because construction really is different. In most businesses, you do the work, you invoice, you get paid, and the timing roughly lines up. In construction, it doesn't. Your costs, materials, plant hire, and especially subcontractors, are often incurred up front, while your revenue trickles in progressively over months, subject to claims, disputes, and retentions. The result is a structural vulnerability that catches out even well-run, genuinely profitable builders. You can be making good margins on every job and still find yourself sweating over whether you can meet next week's payroll. That's not a sign of a bad business. It's the nature of construction cash flow. And the good news is, it's manageable once you understand the moving parts. And that disconnect between when the money goes out and when it comes back in is the single thread running through everything else we'll cover today. Let's name those moving parts. First, revenue is recognized progressively over the life of a project, but your costs land early. You're buying materials and paying subbies long before the matching cash comes in. Second, your progress payments are exposed. Clients can delay them, dispute them, or apply retention deductions, typically 5 to 10%, held right through to practical completion. And third, while your cash in is being held up, your cash out isn't waiting. Security of payment legislation sets strict timeframes for paying your subcontractors. So you have money going out early on a legal clock, while money comes in late and only partially. That's the construction squeeze in a single sentence. Understand that one dynamic, and almost everything else about construction finance starts to make sense. Let's look at the levers you can actually pull, starting with progress claims, because the timing of your claims has a direct, immediate impact on your cash position. A good construction accountant helps you do three things here. First, structure your progress claim schedule to bring cash in as early as you legitimately can, front-loading where the contract allows. Second, prepare the supporting documentation that minimizes disputes, because every disputed claim is a delayed payment, and delayed payments are exactly what hurt. And third, account for your revenue correctly under AASB 15, the accounting standard that governs revenue recognition on construction contracts. Get the claims right, and you pull cash forward while reducing the friction that holds it up. Next, retentions. And this is the one builders most often underestimate. A retention is a slice of each progress payment, typically 5 to 10%, that the client holds back until practical completion and the end of the defect's liability period. On a single job, it feels minor, but across several concurrent projects, those slices add up into a serious amount of working capital that's just sitting there, unavailable to you, sometimes for a year or more. The fix is a rolling retention schedule, a live record of what's being held, on which project, and when each amount is expected to be released, so you can actually build it into your cash flow forecast. And note a legal point. In several states, retention money must now be held in trust accounts, which is a separate compliance obligation in its own right. A practical tip: review your retention schedule at the same time you review your forecast, so those held amounts are never out of sight and out of mind. Now the other side of the clock, subcontractor payments. Security of payment legislation operates in every Australian state, and it gives your subcontractors legally enforceable rights to be paid within prescribed timeframes. This is not an area to be casual about. If you fail to respond to a payment claim within the statutory timeframe, or fail to pay by the due date, the consequences are real. A statutory debt, adjudication proceedings, even licensing issues. So you need robust systems to track subcontractor invoices, respond to payment claims on time, and process payments by their due dates. And those systems have to be supported by an accounting function that genuinely understands the legislative framework, not one that treats a payment claim like an ordinary invoice.
If you're a Queensland builder, there's an extra layer, the QBCC. Many Queensland construction businesses holding a QBCC licence face annual financial reporting under the Minimum Financial Requirements Policy. Reporting that demonstrates your net tangible assets meet the threshold for your licence category. Now, the exact obligation depends on your licence type and category, and there's been a recent change worth knowing. From the 7th of March 2025, individual licensees in the self-certifying SC1 and SC2 categories no longer need to lodge MFR financial reporting. Company licensees in those categories, and all licensees in categories 1 to 7, still do. Quantum House are specialist QBCC accountants. We prepare and lodge these reports and monitor your NTA position throughout the year, not just at the deadline. Let me put a number on the retention point, because it's so easy to miss. Imagine you're running 3 projects at once. On Project A, the client is holding $45,000 in retention. On Project B, $55,000. On Project C, $40,000. Individually, each feels like a rounding error against the project value. But added together, that's $140,000 of your money, your profit effectively, locked away, none of it released until each job reaches practical completion, potentially many months down the track. If you're not tracking that as a single living number, it's an invisible drag on your business. A rolling retention schedule makes it visible, and once it's visible, you can plan around it. These figures are illustrative, but the pattern is very real. And multiply that across a busy year, with jobs starting and finishing at different times, and the amount tied up at any given moment can be larger again. Let me bring it all together with a short hypothetical example. Picture Hadfield Construction, a fictional commercial fit-out builder running 3 projects at once. On paper, all 3 were profitable, and yet cash was constantly tight, and the owner genuinely couldn't work out why. A construction-specific review found the answer in 2 places. First, retentions. Across the 3 jobs, around $140,000 was being held by clients, none of it due for release until practical completion months away. And the owner had never tracked it as a single number. Second, timing. A major progress claim had been submitted late and then queried, delaying about $90,000 of cash by 6 weeks. And that 6 weeks landed precisely when subcontractor payments fell due under security of payment timeframes, with payroll still to run. So they built 2 things, a rolling retention schedule and a 13-week forecast built around their progress claim and retention release dates. Suddenly the picture was clear and manageable. They tightened their claim documentation to reduce disputes, sequenced their claims to bring cash forward, and planned around the retention releases. The profit had always been there. It was simply locked up in retentions and mistimed claims. Illustrative only, of course, but it's exactly how a profitable builder ends up feeling broke. So what does good look like in practice? Think of it as a construction cash flow toolkit with 4 parts. 1. A 13-week cash flow forecast built specifically around your progress claim dates and your retention release dates, not a generic template. 2. A rolling retention schedule, tracking every retention by amount, project, and expected release date. 3. Claim discipline, well-documented progress claims, sequenced to bring cash in early and to avoid the disputes that cause delays. And 4. Subcontractor payment systems that track claims and ensure you pay within the security of payment timeframes. None of these is complicated on its own,
But together, they turn cash flow from a source of constant stress into something you actively control. And the real benefit compounds. The longer you run these habits, the more accurate your forecasting becomes, and the fewer nasty surprises you face.
A few pitfalls to watch because they're the ones we see again and again. The first is simply not tracking retentions, letting that working capital sit invisible across your jobs until it surprises you. The second is late or poorly documented progress claims, which invite disputes, and every dispute is a cash delay. The third is missing security of payment deadlines. That's not just a cash problem, it's a legal one, risking statutory debt, adjudication, or license issues. And the fourth, underneath all of them, is treating profit as cash. A healthy profit and loss statement tells you nothing about whether you can make payroll this Thursday. Avoid those four, and you've avoided most construction cash crises. Let's pull it together. Construction is structurally cash vulnerable. Costs come early, cash comes late. Time your progress claims and document them well, accounting under AASB 15. Track your retentions with a rolling schedule because across projects, they really add up. Meet your security of payment timeframes for subcontractors without exception. If you're in Queensland, know your QBCC reporting obligation, including the 2025 change. And above all, forecast around your claim and retention dates, not your profit and loss. That's the shift from reacting to controlling.
This is where Quantum House Australia comes in. We have specialist experience in construction company accounting, cash flow forecasting for long projects, retention management, QBCC reporting, and subcontractor payment compliance. We work with construction businesses of every size, from residential builders to commercial contractors and civil engineering firms. And because so much of construction's cash pressure is bound up in legal frameworks, security of payment claims, adjudication, contract disputes, we can draw on our colleagues at Australian tax experts, tax advisors and lawyers, so the accounting and the legal expertise work side by side, in one place. For a builder, that combination is hard to beat. In practice, that means you're never bounced between an accountant who doesn't grasp the contract and a lawyer who doesn't grasp the numbers. It's one team, both disciplines.
So here's the thought to leave you with. If your construction business is profitable, but always chasing cash, that usually isn't a profit problem, it's a timing problem. And timing problems can be solved. Quantum House Australia brings specialist construction accounting to your cash flow, your retentions, your QBCC obligations, and your subcontractor compliance. Visit quantumhouse.com.au or call our Sydney office on 1-300-809-697. Thanks for watching. Quantum House Australia, accountants and tax advisors, setting a new standard.